April, June of this quarter. So they may raise the April, June quarter forecast and then reduce it somewhere during the course of the year to keep 7% intact is what my expectation would be. On inflation, it's too early to make any changes. The numbers are looking good as of now. The May inflation number is again supposed to come below 5%, around the same number, 483, that we got in April. So I don't think RBI needs to change anything on inflation and growth. As far as surprises are concerned, as you mentioned, if there is a change in stance, because we know ECB has cut yesterday, Bank of Canada has cut. So if RBI says that we are forward-looking and we're just keeping that optionality with us for changing the stance, which would have them the optionality of either pausing or cutting or hiking, that could be a surprise for the market. And I don't think at this stage they will talk anything about OMO sales or anything because government is sitting on cash balances. They have to actually spend the money for the liquidity to come inside the system. So it's too early. But these are the two surprises that could come, either the change of stance or anything related to liquidity or OMO sale. But I'm not expecting any of these in today's announcement.
Okay. Yeah, we were once expecting a huge dollar inflow because of bond and perhaps equity performance because of a stable government. Now that's got, we have seen huge equity outflows actually, dollar outflows over the past 2 days. So maybe the liquidity problem will also be a wait and watch problem. But Lakshmi, Kaushik set it up nicely. There are two central banks that have already cut globally, even if one is a hawkish cut. As well, you look at the inflation forecasts. First quarter 4.9, then 3.8, then 4.6, then 4.5. For the first time, we have an inflation forecast series, all of which is with a handle 4. So you think overall, can there be a slightly dovish tilt at all?
Hi Lata, morning. So yes, the chances of having a slightly dovish tilt in the narrative, maybe more in the talk and obviously lesser in the walk, could be possible. And that, I would say the key trigger for that, apart from the rate cuts that we saw, both, Canada and the ECB, not necessarily it is going to be a prolonged or a continued rate cut, but also the fact that, there has been a bazooka of money that they've received from the RBI. And given the fact that, while I'm cognizant of the fact that industrial metals are up 20% in the last 3 months, crude oil prices are down 15%. Though inflation is still, the war still continues. So I think all of that can lead to a little bit mellowing in terms of tonality. I think that's the least one can do in this kind of a scenario. But yeah, it's just too premature. And outer chances, we've seen that in politics, we can't rule that out in policy as well. Very outer chance that there could be probably some tweak in terms of the stance.
Well, yes, the RBI certainly will want to hear what happens in the July budget. But Parul, I know your base case scenario is no change in stance, rates, inflation or GDP forecasts. But is there any surprise you're expected going into the policy today? What will you watch out for?
So we'll watch out for a couple of things. One, their language on growth. So growth has been surprising on the upside, especially versus most of the forecasts in the market, and even higher than what RBI has been forecasting. Last year's GDP at 8.2%. Next year's forecast, we don't expect them to change. But how strongly confident is RBI of next year's growth at 7 or above? That's what I'll watch out for. The other is the voting pattern. So if we go through Dr. Ashima Goyal's commentary in the minutes, she was really dovish. Although she voted for no change in stance or the rates, the commentary was hugely dovish. What it tells me is that RBI, they have the room to cut. They have the room to become neutral from the inflation, especially from the inflation standpoint and the trajectory as it's unfolding, monsoons, how they're expected to unfold. But they're just keeping their options open. So like my other co-panelists said, any change in language tilting slightly towards dovish, that is expected. The stance change, we are not expecting today, just because globally, there are a lot of uncertainties and even locally now with the election results. But yeah, anytime if they give a surprise, they have the room to, and the market will react accordingly.
All right. And Mr. Indranil Pan, what is your expectation? Do you think RBI is going to make use of this opportunity or, like the rest of the panelists were saying, perhaps a wait and watch mode until they hear more from the government?
Well, I think the slight difference between the other panel and me is I definitely don't expect any change in the stance also, leave aside any rate cut. I think if I were to take a leaf out of the last minutes, they would continue to watch the monsoon scenario, and especially in the heat wave conditions, we are still to assess the type of sort of crop damage that could have happened. For us, the next inflation reading is trending closer to the 5% rather than the 4.8% number. And that is also because some amount of upside that we have seen in terms of the vegetable prices. So there continues to be huge amount of uncertainty. But one of your panelists did mention that the commodity prices continue to be sticky. But if I look at the Brent crude from 76, 77 levels is back to around 80. So there's a lot of uncertainty there in terms of the OPEC plus stance in the future months of the year. So that's something that needs to be tracked. And RBI's own analysis does say that the survey of service sector providers, they are expecting some amount of pass through of the higher input cost to the end users, though the manufacturing sector said that they are not likely to pass it through. So my focus will actually come back on the core inflation part, given that the growth remains quite solid and strong, which provides the room for manufacturers as well as service providers to pass on the higher input costs to the end users. So the trajectory in terms of the core inflation, which has been on the softer side, and that is also to a certain extent due to the base effect of the last year, is also going to be around. And by end of the year, we will possibly be closer to a 4.2, 4.3% even in terms of the core. And that sort of provides for a situation where the assessment in terms of the incoming data becomes even more important, and also around the monsoon and the spread and timeliness of the monsoon.
Yep. No, we have to remember that at the moment it's a 200 basis point gap between the inflation for FY25 average forecast and the repo rate, which can be considered tight. I mean, of course, Jayant Verma has argued that, and that's why this expectation of dovishness at some point. But Lakshmi, you know, we did see 6.94 on the 10-year yield for a day at least after the exit poll, and then we saw 7.03 and 0.02. It's even after a reasonable assurance of a stable government, the yields have not come back as much as the stocks came back. Do you think the RBI can do anything to bring yields down, or is this entirely a prisoner to the budget?
Lata, see the amount of dividend transfer, the detailing of that is what the markets are keen to see. How much of this will go towards the fiscal deficit reduction? How much of this actually gets routed towards incremental capex? I think some of those devil in the details is what the market is clearly looking out for. We have seen some softening in the US yields, and of course there are key data impending even today. So I think all of that is clearly playing on the sentiment, and not just the budget or not just the political outcome. Yes, budget will play a very critical role in shaping up these expectations. And not to forget that the FPI flows, I think that also is getting tracked. Though the month of May also saw net sales positive, the number was a tad lower compared to the past few months. So I think these are the current things which are playing on the market moods and sentiments right now. But doesn't look like anyone is really letting go of positions in the bond markets for now.
Okay, very quickly, I think we'll have about 90 seconds. Parul, you want to dwell on that? Anything that he can say that can bring yields down?
So any positive comments on liquidity, or even on the stance or some direction that tells the market that RBI is softening, either on the growth expectations, that will directly have impact on both the interest rate swap levels and on the bond yield levels. To just give you some sense of what market is pricing in, we are pricing in a rate cut of 25 basis points only, and that too as far out as in the month of February or April of next year. any hint of RBI becoming confident of inflation remaining under control or growth slowing down will just make the market move that pricing forward, which can come to October, December, and also increase the rate cuts from just 25 to 50 basis points. That will be enough to move the markets by 10 to 15 basis points easily. So all in hands of RBI. But like things stand, people are just delaying all expectations because they've been disappointed before. And therefore, nobody wants to come out and say that they expect rates to move lower.
Okay, yes, we are in the shadows of such a big political surprise that perhaps no one wants to take any chance and say things will be status quo or business as usual. Business is anything but as usual at this point in time. I think we are counting seconds to the governor taking the mic. And of course, all these will be eagerly watched, whether there'll be even a slight tremor to the withdrawal of accommodation. At the moment, the stance is withdrawal of accommodation until inflation comes towards the 4% mark, gets aligned to the 4% mark. So does that word, does that phrase make its appearance again will be very important. And of course, any tinkering to the growth and the inflation forecast. On liquidity, actually, the Reserve Bank has an easier job, but the governor is there to say that for himself.
Financial year, and this is how it goes. In the recent years, the world has gone through one crisis after another, and the pattern continues. Even against this backdrop, the Indian economy exhibits strong fundamentals together with financial stability and positive growth momentum. Nevertheless, we need to remain vigilant in an unsettled global environment. The new realities brought about by technological advancements, supply chain realignments, trade and financial fragmentation, and climate change pose opportunities as well as challenges. In this milieu, India looks ready to embark upon a new era of transformation aided by a favorable demography, improving productivity and technology, and a conducive policy environment. The confluence of these factors brightens the prospects of sustained high growth in India in the years ahead. As the Reserve Bank approaches its centenary year, that is RBI at 100, it will gear up even more to remain future ready for India's fast-growing economy. It will take steps to enhance India's global footprint. For our journey during the next decade, we have drawn up strategies consisting of policy actions towards positioning the Reserve Bank as a model central bank of the global south. The agenda for the run-up to RBI at 100 is documented in the annex to this statement. I urge all keen observers of the Indian economy and the financial system to take a close look at these action plans. This is not a static document. It cannot be a static document, as we are living in a dynamic world. Our endeavor will be to continually update it as may be required from time to time. I would now turn to the decisions and deliberations of the Monetary Policy Committee. The Monetary Policy Committee met on 5th, 6th and 7th June. After detailed assessment of the evolving macroeconomic and financial developments and the outlook, the MPC decided by a 4:2 majority to keep the policy repo rate unchanged at 6.5%. Consequently, the standing deposit facility, that is SDF, rate remains at 6.25%, and the marginal standing facility, that is MSF rate, and the bank rate at 6.75%. The MPC also decided by a majority of 4 out of 6 members to remain focused on withdrawal of accommodation to ensure that inflation progressively aligns to the target while supporting growth. I shall now briefly set out the rationale for these decisions. The inflation growth balance is moving favorably. Growth is holding firm. Inflation continues to moderate mainly driven by the core component, which reached its lowest level in the current series in April 2024. The deflation in fuel prices is ongoing. Food inflation, however, remains elevated. While the MPC took note of the disinflation achieved so far without hurting growth, it remains vigilant to any upside risks to inflation, particularly from food inflation, which could possibly derail the path of disinflation. Hence, monetary policy must continue to remain disinflationary and be resolute in its commitment to aligning inflation to the target of 4% on a durable basis. Sustained price stability would set strong foundations for a period of high growth. Accordingly, the MPC decided to keep the policy repo rate unchanged at 6.5% in this meeting of the MPC. The MPC also decided to remain focused on withdrawal of accommodation to ensure anchoring of inflation expectations and fuller policy transmission. I would now like to provide an assessment of the growth and inflation conditions. Let me first briefly touch upon global growth. Global growth is sustaining its momentum in 2024 and is likely to remain resilient, supported by rebound in global trade. Inflation is easing, but the final leg of this disinflation journey may be tough. Central banks remain steadfast and data dependent in their fight against inflation. Market expectations regarding timing and pace of interest rate cuts are also changing with incoming data and central bank communication. US dollar and sovereign bond yields remain range bound. While gold prices have surged on safe haven demand, equity markets have gained in both advanced and emerging market economies since the last MPC meeting in April. Let me focus now on the domestic growth conditions. The provisional estimates released by the National Statistical Office, NSO, placed India's real gross domestic product, that is GDP growth, at 8.2% for the year 23-24. During 24-25, that is during the current year so far, domestic economic activity has maintained resilience. Manufacturing activity continues to gain ground on the back of strengthening domestic demand. The 8 core industries posted healthy growth in April 2024. Purchasing Managers Index, that is PMI in manufacturing, continued to exhibit strength in May 2024, and it is indeed the highest globally. Services sector maintained buoyancy as evident from available high-frequency indicators. PMI services stood strong at 60.2 in May 2024, indicating continued and robust expansion in activity. Private consumption, the mainstay of aggregate demand, is recovering. And it is recovering with steady discretionary spending in urban areas. Revival in rural demand is getting a fillip from improving farm sector activity. Investment activity continues to gain traction on the back of ongoing expansion in non-food bank credit. Merchandise exports expanded in April with improved global demand. Non-oil, non-gold imports entered positive territory. Services exports and imports rebounded and posted a strong growth in April this year. Looking ahead, the forecast of above normal southwest monsoon by the Indian Meteorological Department, that is IMD, is expected to boost Kharif production and replenish the reservoir levels. Strengthening agricultural sector activity is expected to boost rural consumption. On the other hand, sustained buoyancy in services activity should continue to support urban consumption. The healthy balance sheets of banks and corporates, government's continued thrust on capex, high capacity utilization, and business optimism augur well for investment activity. External demand should get a fillip from improving prospects of global trade. Taking all these factors into consideration, real GDP growth for the current financial year 2024-25 is projected at 7.2%. Let me repeat, the GDP growth that we are now projecting for the current financial year 2024-25 is 7.2%, with Q1 at 7.3%, Q2 at 7.2%, Q3 at 7.3%, and Q4 at 7.2%. The risks are evenly balanced. I would now like to focus on inflation. CPI headline inflation softened further during the months of March and April, though persisting food inflation pressures offset the gains of disinflation in core and deflation in fuel groups. Despite some moderation, pulses and vegetables inflation remained firmly in double digits. Vegetable prices are experiencing a summer uptick following a shallow winter season correction. The deflationary trend in fuel was driven primarily by the LPG price cuts in early March. Core inflation softened for the 11th consecutive month since June 2023. Services inflation moderated to a historic low, and goods inflation remained contained. The exceptionally hot summer season and the low reservoir levels may put stress on the summer crop of vegetables and fruits. The Rabi arrivals of pulses and vegetables need to be carefully monitored. Global food prices have also started inching up. Prices of industrial metals have registered double-digit growth in the current calendar year so far. These trends, if sustained, could accentuate the recent uptick in input cost conditions for farms. On the other hand, the forecast of above normal monsoon bodes well for the Kharif season. Wheat procurement has surpassed last year's level. In fact, the buffer stocks of wheat and rice are well above the norms. These developments could bring respite to food inflation pressures, particularly in cereals and pulses. The outlook on crude oil prices remains uncertain due to geopolitical tensions. Assuming a normal monsoon, CPI inflation for 2024-25 is projected at 4.5%, with Q1 at 4.9%, Q2 at 3.8%, Q3 at 4.6%, and Q4 at 4.5%. The risks are evenly balanced. So thus, as you can see, the GDP growth projection, we have increased it from 7%, which we gave out in the last MPC meeting. We have increased it to 7.2%. And the inflation projection, the average for the year, we have retained it at 4%, as 4.5%, as it was in the last MPC meeting. And I have explained there are good reasons why we have increased the GDP forecast, the GDP projection for the current year. Now, what do these inflation and growth conditions mean for monetary policy? That is the question, and I would like to answer that. The developments relating to growth and inflation are unfolding as per our expectations. When the projected GDP growth of 7.2% for 2024-25 materializes, it will be the fourth consecutive year of growth at or above 7%. Headline CPI continues to be on a disinflationary trajectory. Monetary policy has played an important role in this process. This is evident from the decline in headline inflation by 2.3 percentage points between the first quarter of 22-23 and the fourth quarter of 23-24. Supply-side developments and government measures have also contributed to this moderation of headline inflation. Repeated food price shocks, however, slowed down the overall disinflation process. According to our projections, the second quarter of 2024-25 is likely to see some correction in headline inflation. But this is likely to be one-off on account of favorable base effects and may reverse in the third quarter. If you look at the projections we have given, then it becomes very clear that in the second quarter, the headline inflation is likely to come down to about 3.8%, and thereafter again it goes up. And we have given the numbers in the statement, and I have already read it out earlier. At the current juncture, therefore, the uncertainties related to food price outlook warrant close monitoring, especially their spillover risks to headline inflation. In parallel, the behavior of the core component also needs to be watched carefully. We need a descent of inflation to 4% target on a durable basis while supporting growth. Now, there is a view that in matters of monetary policy, the Reserve Bank is guided by the principle of follow the Fed. I would like to unambiguously state that while we do keep a watch on whether clouds are building up or clearing out in the distant horizon, we play the game according to the local weather and pitch conditions. In other words, while we do consider the impact of monetary policy in advanced economies on Indian markets, our actions are primarily dependent and primarily determined by the domestic growth inflation conditions and the outlook. I have said this several times earlier, but it becomes necessary to restate the position and reiterate this so that there is clarity in the mind of market participants and other stakeholders, and as a result of which they do not board the wrong bus. Liquidity and financial conditions. That is the next part which I would like to highlight. During the current financial year so far, system liquidity transited from surplus to deficit conditions and then again back to surplus in early June. In consonance with the commitment made in the April policy statement of remaining nimble and flexible in liquidity management, and in view of the shifting liquidity dynamics, the Reserve Bank mopped up surplus liquidity through variable rate reverse repo auctions, that is VRRR auctions, during the first half of April, while injecting liquidity through variable rate repo operations, that is VRR operations, in the later part of April and in May. In the first week of June, however, VRRR auctions have been conducted. Banks' recourse to the marginal standing facility, that is MSF, under the liquidity adjustment facility remained low during 2024-25, that is in the current year so far. Now, mirroring the liquidity dynamics which I just explained, the weighted average call rate, that is WACR, on an average remained close to the middle of the corridor. Now, I have explained, for common listeners and for others, I have explained what exactly the corridor means in the footnote. And let me also state here that most of the statements which I am making are backed by data, and the data is given in the footnotes, and I would encourage you to have a look at footnotes to understand why we are making certain statements. So mirroring the liquidity dynamics, as I said, the weighted average call rate, that is WACR, on an average remained close to the middle of the corridor. Across the term money market segment, the yields on certificates of deposit, that is CDs, commercial papers, that is CP, issued by non-banking financial companies, that is NBFCs, and 3-month treasury bills, that is T-bills, also eased. In the credit market, monetary transmission remains ongoing. As you would be aware, the Central Board of the Reserve Bank decided to transfer rupees 2.11 lakh crore as surplus to the central government for the accounting year 2023-24. As the economy remains robust and resilient, the Central Board decided to utilize this opportunity to increase the risk provisioning under the contingent reserve buffer to 6.5% of the Reserve Bank's balance sheet for 2023-24 from 6% in 2022-23. In other words, the contingent reserve buffer, which was 6% in 22-23, was enhanced by the Central Board to 6.5% in the current for the year 22-23. Now this risk provisioning, that is this provision for contingent reserve buffer, or CRB as we call it, this would further strengthen the Reserve Bank's balance sheet. Prudence is at the core of our standard operating procedure. The Indian rupee moved in a narrow range with a low volatility during 2024-25 so far. That is up to June 5th, and that's the figure I have given. Now this has happened despite despite the rupee trading under pressure amidst foreign portfolio, that is FPI outflows. The relative stability of the Indian rupee bears testimony to India's sound and resilient economic fundamentals and its macroeconomic and financial stability and improvement in the external outlook. Looking ahead, the Reserve Bank will, and I'm providing some kind of a forward guidance here with regard to liquidity and our approach to the markets. Looking ahead, the Reserve Bank will continue to be nimble and flexible in its liquidity management through main and fine-tuning operations in both repo and reverse repo. We will deploy an appropriate mix of instruments to modulate both frictional and durable liquidity so as to ensure that money market interest rates evolve in an orderly manner which preserves financial stability. As our actions over the recent period have shown, the Reserve Bank stands committed to maintain stability and orderliness in all segments of financial markets and institutions regulated by it. I would like to read this sentence once again for clarity. And it's not just for clarity, but to reiterate the position. As our actions over the recent period have shown, the Reserve Bank stands committed to maintain stability and orderliness in all segments of financial markets and institutions regulated by it. And this is consistent with our approach, which we have been adopting. Even during COVID times, we adopted the same approach, and thereafter we have continued. So therefore, our focus is to ensure stability and orderliness in all segments of financial markets and institutions which are regulated by the Reserve Bank. I would now turn to financial stability. The annual financial results of 2023-24 indicate that the banking system remained sound and resilient, backed by improvement in asset quality, enhanced provisioning for bad loans, sustained capital adequacy, and rise in profitability. The non-banking financial companies, that is NBFCs, also displayed strong financials in line with the banking sector. Notably, the gross non-performing assets, that is the GNPAs of scheduled commercial banks and NBFCs, are below 3% of total advances at the end of March 2024. It is important that regulated entities should continue to improve their governance standards, risk management practices, and compliance culture across the organization. In November last year, we had flagged certain concerns on excessive growth in unsecured retail loans and over-reliance of NBFCs on bank funding. Recent data suggests that there is some moderation in these loans and advances. We are closely monitoring the incoming data to ascertain if further measures are necessary. The boards and top management of regulated entities should ensure that risk limits and exposures for each line of business are kept well within their respective risk appetite framework. The persisting gap between credit and deposit growth rates warrants a rethink by the boards of banks to re-strategize their business plans. A prudent balance between asset and liabilities has to be maintained. Customer protection remains on top of the Reserve Bank's priorities. In general, we have observed that the guidelines on key fact statement, in fact, I have explained key fact statement also in the footnote. The customer protection, as I'm just repeating, customer protection remains on top of Reserve Bank's priorities. In fact, it would be of interest to you that in this year's annual report, we have a separate box item which lists out the customer-centric measures that the Reserve Bank has taken. And in the same vein, we have also a box item in the annual report which has just been released recently. There is a box item on the number of regulatory measures which were taken after carrying out stakeholder consultations. And these two box items, I would encourage those who are interested to please have a look at them. So in general, we have observed that the guidelines on key fact statement are followed. But a few regulated entities still charge fees, etc., that are not specified or disclosed in the key fact statement, that is KFS. It has also been observed that in some microfinance institutions and NBFCs that the interest rates on small value loans are high and appear to be usurious. The regulatory freedom enjoyed by the regulated entities in respect of interest rates and charges should be used judiciously to ensure fair and transparent pricing of products and services. The Reserve Bank continues its constructive engagement with such financial entities to safeguard the interest of customers and ensure overall financial stability. Now let me make it very clear that we are observing all these trends, and our focus is always to interact, to engage with the sectoral players, to engage with the individual banks or NBFCs or the MFIs and encourage them to take necessary corrective measures, because it's for the regulator and the regulated entities together. We have to work to ensure that your health, that is the health of the banks and NBFCs and the microfinance institutions, remain robust, the health remains good, and if that happens and when that happens, it's good for the economy. I'm not saying that there is any big amount of problem at the moment. Overall, as I have said, let me again re-emphasize the banking sector, the NBFC sector, the MFI sector, overall financial sector remains healthy and stable. But there are a few outliers and I was mainly focusing on them. Let me now turn to the external sector. With lower trade deficit, robust services export growth and strong remittances, the current account deficit is expected to have moderated in Q4 2023-24. Services exports were predominantly driven by software exports. Other business services and travel services exports were predominantly driven by software exports, other business services and travel exports. The phenomenal rise in global capability centers, that is GCCs, in India has provided a significant boost to India's software and business services exports. India, with an expected 15.2% share in world remittances in 2024, continues to be the largest recipient of remittances globally. Overall, the current account deficit for the current year, that is 2024-25, is expected to remain well within its sustainable level. On the external financing side, foreign portfolio investment, that is FPI flows, surged in 23-24 with net FPI inflows of around US $41.6 billion. Since the beginning of 2024-25, however, foreign portfolio investors have turned net sellers in the domestic market with net outflows of US $5 billion till June 5. In 2023, India retained its position as the most attractive destination for greenfield foreign direct investment, that is greenfield FDI in Asia and Pacific. Gross FDI remained robust in 23-24, but net FDI moderated. External commercial borrowings, that is ECBs, and non-resident deposits recorded high net inflows as compared with the previous year. The amount of ECB agreements also grew markedly during the year. Now, I have given the relevant data in the footnotes. Now, touching a new milestone, India's foreign exchange reserves reached a historical high of US $651.5 billion as on 31st May. India's external sector remains resilient and the key external vulnerability indicators continue to improve. Overall, we remain confident of meeting our external financing requirements comfortably. I shall now announce certain additional measures, and there are, I think, about there are few of them. And at the end, in the concluding para, I would like to also provide some guidance for, the way forward. The first announcement relates to review of limit for bulk deposits in banks. On a review of bulk deposit limit, it is proposed to revise the definition of bulk deposits as single rupee term deposit of 3 crore, rupees 3 crore and above for scheduled commercial banks, excluding the regional rural banks, and this also is applicable, that is from, this definition of single rupee term deposit of 3 crore is applicable to both scheduled commercial banks and SFBs and not RRBs. Further, it is also proposed to define the bulk deposit limit for local area banks as single rupee term deposit of rupees 1 crore and above as applicable in the case of RRBs. The next announcement relates to rationalization of guidelines for export and import of goods and services under the Foreign Exchange Management Act, that is FEMA 1999. In view of the changing dynamics of international trade and in line with the progressive liberalization of foreign exchange regulations, it is proposed to rationalize the extant FEMA guidelines on export and import of goods and services. This will further promote ease of doing business and provide greater operational flexibility to authorized dealer banks. Draft guidelines will be issued shortly for stakeholder feedback. The next announcement relates to setting up of a digital payments intelligence platform. The Reserve Bank has taken a number of measures over the years to deepen digital payments while ensuring their safety and security. These measures have boosted consumer confidence. Growing instances of digital frauds, however, highlight the need for a system-wide approach to prevent and mitigate such frauds. It is therefore proposed to establish a digital payments intelligence platform for network-level intelligence and real-time data sharing across the digital payments ecosystem. To take this initiative forward, the Reserve Bank has constituted a committee to examine various aspects of setting up this platform. The next announcement relates to inclusion of recurring payments with auto-replenishment facility under the e-mandate framework. The adoption of e-mandates for recurring payment transactions has been increasing. It is now proposed to include payments such as replenishment of balances in FASTag, National Common Mobility Card, that is NCMC, etc., which are recurring in nature but without any fixed periodicity in the e-mandate framework. This will enable customers to automatically replenish the balances in FASTag, NCMC, etc. if the balance goes below the threshold limit set by them. This will enhance convenience in making travel and mobility related payments. The next announcement relates to introduction of auto replenishment of UPI Lite wallet, and it also includes inclusion under the e-mandate framework. UPI Lite was introduced in September 2022 to enable small value payments in a quick and seamless manner through an on-device wallet. To encourage wider adoption of UPI Lite, it is now proposed to bring it under the e-mandate framework by introducing a facility for customers to automatically replenish their UPI Lite wallets if the balance goes below the threshold limit set by them. There could be some, I think if you want better clarity, this statement will be uploaded immediately after my, my address, my statement is over in the next couple of minutes. So please have a look at the uploaded version. That will give you clarity. We try to avoid long sentences, but sometimes it becomes difficult and unavoidable. So please bear with me. Now this measure will further enhance the ease of making small value digital payments. And the final announcement relates to Harbinger 2024. innovation for transformation. The Reserve Bank has taken several pioneering initiatives in recent years to encourage innovation in the fintech sector. One such key initiative is the global hackathon, that is Harbinger Innovation for Transformation. The first two editions of the hackathon were completed in the year 2022 and 2023. The third edition of the global hackathon, Harbinger 2024, with two themes, namely Zero Financial Frauds and being Divyang Friendly, will be launched shortly. Let me now conclude. At the Reserve Bank, our job demands poise, patience and perseverance. India's recent economic progress, continued momentum in economic activity and the overall promising economic prospects validate our approach to policy making. At the moment, the Indian economy is at an inflection point in its path towards greater transformational changes that will bring about more stability and growth. On inflation, we are on the right track, but there is still work to be done. Globally, there are concerns that the last mile of disinflation might be protracted and arduous amidst continuing geopolitical conflicts, supply chain disruptions and commodity price volatility. In India, with growth holding firm, monetary policy has greater elbow room to pursue price stability to ensure that inflation aligns to the target on a durable basis. In its current setting, monetary policy remains squarely focused on price stability to effectively anchor inflation expectations and provide the required foundation for sustained growth over a period of time. The words of Mahatma Gandhi resonate here, and I quote, "If we are sure of our path," I repeat, "if we are sure of our path, we should go on striving for it incessantly and uninterruptedly." Thank you. Namaskar.
Okay. If you thought that there are no surprises, well, the governor has disappointed us. In fact, has surprised us with a very big one. Growth upped to 7.2%. There was an expectation that, after that blockbuster Q4 number, there is a chance, but after the political uncertainty, those hopes got watered down. But the governor has come with a 7.2% growth upgrade from an already high 7%. I think there are two people, at least SBI and Citi, which are in the 7% plus category. But this will be a surprise to the rest of the economists. And CPI, I think it's important to note the vote. While it is the interest rate and the stance has been maintained as in the previous policy, the interest rate support has come only from 4 out of the 6 members and not 5 as was previously the case for the stance. In fact, for the rate, I think it was a full house that supported last time. This time there are 2 people asking for a rate cut. So that puts the, expectation of a rate cut a little more in people's view. But to be fair, the governor was absolutely clear in his tone that the Reserve Bank is cognizant of, inflation, the last mile inflation coming down being difficult all over the world. And therefore, it doesn't look like it's very imminent. But clearly the fact that 2 people are asking for both a change of stance and a change in rates or a lowering of rates is very important. It can't be bypassed. So growth higher and inflation likely a small, foothold that things could get dovish in the year makes for an excellent policy for at least the stock markets. I was just noticing the bond market, not much of a move. I mean, it was 7.019 before we went into the policy. It is 7.018 after the policy. So not much of a change over there. Let me get our experts to comment. We've got Kaushik Das, Upasana Bharadwaj, we've got SBI Managing Director Mr. Sethi, Shobit Mehrotra from HDFC Asset Management, Rajiv Anand from Axis Bank, and in a bit even Mr. Ashwini Kumar of UCO Bank will be joining us. Well, first to the economists. Upasana, 7.2 will you be pushed to upgrade your own forecast?
Lata, we are surprised with that upward revision. We were expecting them to retain it. We are actually expecting 6.9%. So we were already lower than what RBI was earlier estimating. So this upgrade, of course, I mean, probably they've taken cognizant of the overall previous revisions and done some changes. But we believe that somewhere the global slowdown in the second half of the year will start pinching, and we will see some slowdown then. So I think it's a little optimistic, but we'll see how things fare. At least for the month of April and early indicators of May, growth has held up well. So the first quarter may still tick off as per RBI's expectations. But beyond that, I will have to remain a little watchful. But otherwise, I would say that besides the GDP upgrade, overall, the policy is fairly in line with what probably we were expecting or the markets were also expecting. It's a fairly balanced tone that RBI governor has maintained. And, the emphasis and the complete focus still remains on ensuring that the 4% last mile disinflation will have to be attained, and they have to get the confidence before they can really act. I think that is one big key takeaway. But besides that, I think it's a very balanced tone, and that's fairly positive otherwise.
Yep. Actually, even if the bond markets have not moved, if anything, very marginally, the stock markets have clearly given a big thumbs up. At the moment, almost racing to 1% gain. So the upgrade in growth is perhaps, stock markets normally look at central banks as the conservative element. And if the conservative element is talking about a 7.2% growth, then the market has something to cheer, at least at this point in time. Kaushik, key takeaways?
The upgrading growth is a good development, but we have to think whether that upgrade will come with some bit of monetary easing or it will come on its own. I would guess that in order to get a 7% plus growth in FY25 on the back of 8.2 last year, and the fact that fiscal consolidation will continue, you can't maintain this kind of momentum unless you give some monetary policy easing. And today we have made one step closer to that by 2 members calling for a rate cut. So we are making all these baby steps towards a monetary easing cycle. Probably by the time we come to the October-December quarter, we could end up getting some rate cuts, because remember, monetary policy is always forward-looking and it takes time for transmission to take place over a next few quarters. So I guess 7.2%, you are mentioning that inflation number all were below 5%. It's still been maintained at 4% handle for all the quarters. But now if you see the growth numbers, everything is above the 7% handle. So it's kind of a balanced kind of number between growth and inflation. The other thing which Governor spoke a lot about and which is important too is the financial stability angle, that whether you look at the banking system or you look at the financial system or the external sector, everything looks pretty strong. And going forward also, RBI will make sure that the macro financial stability remains strong. So I would guess, like, by the time we are October, December, by that time the Fed has already moved, we could end into a rating cycle starting from that quarter.
Okay. Well, once again, I'm lured by the markets. The governors of 7.2% has certainly taken the stock markets, the stock indexes, the Nifty index above the 23,000 mark. We have been there, done that, but after that big receding of the markets, this will definitely come as a bullish shot in the arm for the markets. Shobit Mehrotra of HDFC AMC is with us. Any thoughts, takeaways for the bond market?
Lata,
Shobit?
I think, Lata, I think the big takeaway for the market is going to be that the fiscal position, which is already pretty strong in a high growth environment, in a positive growth environment, I think the fiscal position would continue to be the hallmark for the bond market. I think 5.1, even if it is not improved in the full year budget, even if we have just at 5.1, I think achieving or bettering that by the March 25 is still a distinct possibility, which means collections will be solid, robust, GST collections, direct taxes, indirect taxes, both can contribute to improving the fiscal position. And for bond market, I think with
Got it.
JP Morgan bond index inclusion, flows, and fiscal remaining positive, I think bond market yields will held low.
Wait, no. Okay. All right. So the long and the short of what you're saying is that you're more looking at budget and Delhi, that the bond market is at the moment slightly less interested in what Reserve Bank is saying. I can see that. That's what we started with. Now let me get to the big bankers. Mr. Sethi, the Managing Director of State Bank, is with us. Mr. Sethi, first your overall takeaway, but more importantly, this redefinition of bulk deposits. I thought it used to be 2 crore and above. Now they've made it 3 crore and above. How does that change a banker's life?
Lata, first I would like to say a few words on the positives. Of course, as you mentioned, the growth upgrade is definitely extremely positive. And though our house view, as you mentioned, was above 7, I think it was around 7.5 if I remember correctly. So, but 7.2 coming from the central bank is definitely a positive. And moderating inflation, though the RBI seems to be very firm that the 4% level has to be reached before the stance or any other things are revisited. On the rates and the stance, of course, is on the expected lines, as everybody mentioned, more in terms of the growth forecast being higher. And also a few things what Governor mentioned in terms of 8 core industries doing very well. In fact, that is also getting reflected in the first quarter. Credit growth usually used to be, a little moderate in the corporate side, but we see a continued growth in the corporates. The other things, very important things, what Governor mentioned in terms of systemic liquidity. I think system liquidity is positive currently. But what we have seen is that normally system liquidity comes into positive territory during the first 1 week and 10 days, and then it gets into the deficit as the advanced tax payments and the GST payments start, moving out rather. And that is where I think the comfort what Governor furnished in terms of being nimble and flexible, both by way of VRR and VRRR, which we have seen in the last several months, that that liquidity support what RBI has been providing to the market to ensure that there's no problem of liquidity. I think the fourth piece, important piece, is in terms of the deposit and credit growth rates, gap increasing. That I think has been there for quite some time because of the very significant credit growth which was happening, and also some of the financialization of to other than deposits which has been happening in the savings. But I think RBI also seems to be a little concerned in terms of wholesale deposits. You have rightly said that it used to be 2 crores on the bulk deposit definition. It used to be 1 crore a few years ago, and increased to 2 crores, and now increased to 3 crores, which means they probably are sending a signal that don't depend too much on the wholesale deposit growth to fund the credit growth. Banks like SBI, of course, with the huge franchise, have ability to raise the retail deposits, but even other banks also are mindful of the margin pressures, and I'm sure everybody would be focusing on the retail deposit growth rate. So these are a few things I thought I would share with you.
Yeah, sure. Mr. Sethi, because of this redefinition of bulk deposit, do you think that credit growth could slow down a bit? Because there could be some smaller banks which now have to run for retail deposits a little harder. Do you see a rise in deposit rates and therefore any impact on credit growth as well, Mr. Sethi?
I don't see direct impact on the credit growth, but I think definitely there would be higher cost which some of the banks have to pay for the bulk deposits. I think, or maybe, even the readjustment in the retail deposits also is required to be done.
All right. I'm just going to take, the focus away from the macros for a bit, because there was a lot that the Reserve Bank of India governor said about regulated entities. While he acknowledged that banks and NBFCs, have a very strong, healthy balance sheet, gross NPAs have come down significantly, he repeated a warning that as far as charging of rates and fees is concerned, in the key fact statement, for instance, the Reserve Bank of India has observed that there are still some MFIs, NBFC MFIs, that are charging very high usurious rates, and the Reserve Bank of India governor almost warned them, saying, we've been engaging with these entities, and if we continue to see these kind of observations, there will be action. The second, of course, as Mr. Sethi was also highlighting, there continues to be a deposit credit mismatch. That is again something that the Reserve Bank of India governor has highlighted before, again bringing to the fore. And the third thing, of course, is RBI said that since raising the risk weights in November last year, yes, the unsecured lending book that has continued to come down, which is visible from the latest data from the Reserve Bank of India. But he also said that the Reserve Bank will closely monitor data to ascertain if further measures are needed, to monitor this unsecured, unnecessary, this large growth in unsecured lending. So those are some of the things that he said, about banks and NBFCs that we'll keep a focus on. But Mr. Rajiv Anand, just to come back to you again on these bulk deposits, the revision of the definition from 2 crores to 3 crores, what would that mean for banks like you, as Mr. Sethi was saying? Perhaps, will there be some impact on the credit front?
No, absolutely not. And good morning to all. I think the move of defining bulk deposits from 2 crores to 3 crores, I don't think is material at this stage. It's just a definitional issue. And I think, to that extent, will not impact either, growth in deposits or, credit, as both you and Lata mentioned. I think the way to think about, what is happening currently is that it looks like there are two markets. At one end, as Shobit mentioned, the long bond is rallying. We're almost at 7%. The fact that the fisc is in pretty good shape, growth will ensure that revenues will continue to be strong into the quarter. And of course, in the JP Morgan index inclusion has meant that the long bond market is quite bullish. But on the other side, if you see liquidity, through the lens of deposit rates up to, let's say, 1 year, those continue to be at elevated levels. Banks are raising money at anything between 7.5 to 7.75, and the hope that banks have really is that as government spending increases, now that the elections are behind us, currency in circulation, comes back, and FX flows happen, that the short end of the curve, which is today, elevated, begins to come off, and there is some semblance of ease of liquidity as we go forward. And I think that is, to my mind, the greater focus as far as banks are concerned.
All right. And, from the statement on, that has now been released on RBI's website, we know that the two MPC members expectedly that voted against both the, rate action and the stance are Dr. Ashima Goyal and Professor Jayant Verma. Kaushik, a quick comment on this. So far, we've been seeing, of course, Professor Jayant Verma, voting for a rate cut. Dr. Ashima Goyal talking about the need for a change in stance. Now, 2 members out of 6 very clearly siding with, a shift in stance, a cut for rates. What would this mean going ahead? Just your quick thoughts on this, Kaushik.
Ritu, the thing is that, as I mentioned, that they're taking one bit closer to the easing cycle. And we've already seen some global central banks like ECB, Bank of Canada, they've started easing rates. The big one, obviously, is the Fed. And today, non-farm payrolls data is coming out. Next week, the US CPI data is coming out. So if they are like a little weaker, expectations of a September rate cut from the Fed could get stronger. And if that were to happen, then it's very possible that in October, December of this quarter, you could have RBI moving and looking to ease rates. And in order to do that, they have to make that transition slowly so that market is prepared. So one way to do it is through MPC members voting their individual, whatever expectations. So you got now, instead of 5:1, 4:2, and by the time you go to August, remember, August will be the last meeting for all these non-RBI MPC members. From October, there would be 3 sets of new non-RBI MPC members. So it's very possible that in August, the numbers could increase in favor of a a change of stance, or there may be an outright change of stance itself, because in July and June, inflation would come down quite significantly. RBI probably could be comfortable by that time to change the stance. And then sometime in October, December, you could start the easing cycle going into 2025. Now, always remember two things. One is monetary policy is forward-looking. So if you have to affect the monetary policy change into real economy, what you do in October, December might take 6 months' time to filter into the real economy. So you're not just going to look at today's number to decide what to do. You are going to look at the next 12 months number on inflation and growth, and then decide what you need to do today. So from that standpoint, I think that move has been made. And the other interesting thing Lata was asking for takeaway, one thing which RBI governor categorically mentioned is that RBI gives more importance to domestic factors while deciding on monetary policy, and not just follow the Fed blindly. It's in a way to say, in my view, my takeaway was that RBI is trying to, kind of make them more independent of the Fed in case the Fed were not to cut at all in 2024, or they have their own problems of fiscal and inflation. Then if the India inflation story improves, then RBI could be in a position to cut rates and not wait for the Fed.
Despite the RBI governor saying that multiple times, I guess the markets have continued to say that the RBI follows the Fed. And, interesting quote there coming in from the governor saying, I want to state that while we do keep a watch on whether clouds are building at the horizon, we play the game according to our pitch conditions. So reiterating that thought again, Mr. Ashwini Kumar, you've been standing by patiently. Just a quick thought on, what you made of the governor's comments on, the growth trajectory also picking up, and what it means for banks like you, especially with the bulk deposit definition being revised.
Good morning to all. As governor also told that this will be the fourth year where we will be targeting 7% growth in a row. And for the banks particularly, if we talk about, I think this is a great opportunity for the credit growth is concerned. And as we have seen good credit growth in the previous years, this year again will be the credit growth opportunities for the banks will be there. So far as the bulk deposit is concerned, it is a correction. I think only that any deposit below 3 crore now will be classified as a retail term deposit, and above 3 crore will be classified as a bulk deposit. It's not going to make much of the difference as far as the raising of deposit is concerned or the raising of resources is concerned. As if I have to talk about, say, UCO Bank, we have been maintaining our bulk deposit in a range, and in 2024, our bulk deposit as a percentage of our total deposit was lower than in 2023. So as a measure, it's a good thing that the growth is coming, credit cycle will again pick up. And one more thing Governor Sir talked about was the customer convenience, giving them e-nudge mandate facility for various additional products also. I think that will improve the customer convenience and stickiness of the customer with the bank.
Okay. Thanks for that, Mr. Ashwini Kumar. I just want to ask the bankers another question on the way the governor has voiced concern on the credit deposit, growth difference. I don't know, to me it sounds like almost reading the Riot Act, but maybe I'm exaggerating. Let me read the paragraph again. In November last year, we flogged certain concerns on excessive growth in the unsecured retail loan and over-reliance of NBFCs on bank funding. Recent data suggests there has been some moderation on these loans and advances. We are closely monitoring the incoming data to ascertain if further measures are necessary. Sounds serious. The boards and the top management of regulated entities should ensure that risk limits and exposures of each line of business are kept well within their respective risk appetite framework. The persisting gap between credit and deposit growth rates warrants a rethink by the boards of banks to re-strategize their business plans. A prudent balance between assets and liabilities has to be maintained. Mr. Sethi, first to you. Does this sound like a warning that more may come?
I don't see as a warning. In fact, the risk weights which have been readjusted in the last policy announcements has indeed, moderated the unsecured loan rate growth in the system. Some banks might have continued the same growth rate, but I think usually we see that the unsecured loan portfolio seems to have been moderated in the growth. But the concern on the deposit growth lagging behind credit growth, I think, is voiced formally, informally by the central bank. I'm sure all of us definitely work on how do we address this issue. It is not to discourage credit growth. I don't read it as a discouraging the credit growth. Obviously, the credit growth is a function of what economy is going to perform. Macros are doing well, and if you have a GDP growth rate of 7.2, and the ballpark estimate is that the credit growth normally is, at least in the corporate side, would be twice the GDP growth rate, which means 14 to 15% credit growth rates will continue. So now we
which is what it is now.
We need to look at how do we strengthen our deposit mobilization. Maybe hopefully without readjusting the rates too much, so that the margins are not under pressure. I think it is more in terms of cautioning that we have to double up on the retail deposit mobilization. That is my reading.
Okay. So, if anything, the pressure on margins could be there, you think, Mr. Sethi?
So, we'll see. I think while the banks have to look at their asset liability mismatches, and if these mismatches are growing, they may have to focus on liabilities. And as I continue to say that every one of the major banks will be focusing on their reach, their marketing, strengthening to raise the deposits without increasing the rates, I think, insignificantly. I think the readjustment on various tenors keep happening. Even SBI has done some readjustment in the tenor-based pricing on the deposits. But I think broadly, we all will be working in terms of focusing how we reach out to the customers and mobilize the deposits. And also, as I think Rajiv was mentioning, the government spending would definitely increase the liquidity, and some of the liquidity definitely would come back to the banks in terms of the deposits. So there will be some easing of pressure on the deposit side.
Okay. Let me get, thank you very much, Mr. Sethi, for that. Rajiv, your thoughts? I mean, we are closely monitoring the incoming data to ascertain if further measures are necessary. Will you take it as business as usual statement?
So I think this conversation between RBI and regulated entities on LDR and unsecured lending is not new. And if you see data of banks of the previous quarter, as Mr. Sethi mentioned, we have seen unsecured lending has slowed, as also LDRs have improved. For some banks a little more, some banks a little less. And I can assure you that both these issues have the attention of the senior management and boards at most large banks. And we continue to do whatever it takes to ensure that we are raising deposits, whether it is current or savings or retail term deposits, as the case may be. But I also want to importantly point out here is that as banks, we are not only looking at LDR, but also the quality of deposits, through improving outflow rates, etc., which is through the LCR mechanism.
Okay, just overall, Rajiv, would you say that there is any pressure on margin at all, even by 1 or 2 basis points, from what the governor is saying, the need to concentrate on deposits?
Lata, I think banks have multiple levers to manage margins. I think the point is that if you see the large repricing of deposits, because of the fact that short-end rates went up quite sharply, I think that is pretty much done. And on the asset side, pricing pressure has somewhat reduced, and banks are also looking to optimize, between NIMs and growth. And so therefore, you will see that margins will be maintained as we go forward.
Okay. All right. Thank you very much, Mr. Sethi, Rajiv, Mr. Ashwini Kumar, Upasana, Kaushik. Am I leaving out anyone? Shobit. Thank you very much. Shobit, just before you go, the yields have come up to 7.02. They were 7.018. I mean, it's not a big change, but why is the bond market suddenly a little worried?
Lata, I think it could be a function of the auction. We have the 10-year benchmark auction scheduled for today.
All right.
So traders might be just creating some room to bid in the auction. So I would not read too much into, a few basis point movement.
Fair enough. Fair enough, fair enough. Well, as you said, at the moment, the bond markets are very rightly focused on Delhi and not on Mint Street because it is the budget and the nature of the deficit that will be their prime concern. Gentlemen and Upasana, thank you very much indeed for parsing the Reserve Bank Governor's statement this morning. I think the Governor has introduced a bit of drama, definitely for the stock markets. The growth estimate has been upped, and that was not anyone's base case. It was not mentioned in the poll. Some of them did mention it last week when Ritu was doing the poll, but this week after the elections, people were, if anything, wondering whether there will be a downward bias to their own growth forecast. The Reserve Bank Governor coming in boldly increasing it by 20 basis points from an already high 7%. 7% is above the median expectation on the street. There are only two forecasts above the Governor that I know, SBI and Citi. So the Governor bringing it up to 7.2 is a very big boost to the stock markets, and we see that 1% rally and the Nifty going up to 23,000 plus. The other positive is that 2 members are now voting against the status quo policy. 2 members want shift to of the stance from withdrawal of accommodation to probably neutral and a cut in the policy rates. That gives some kind of a dovish bias to the entire policy. It means you can't negate, you can't avoid this expectation from 2 of the external members for very long. So probably is there a rate cut somewhere in the horizon, or at least is there a stance change as early as August, is something that the government, that the bond markets will start mulling over. At the moment they are preoccupied with Delhi, but they will start mulling over a stance change as we come closer to the August policy. Ritu, thank you very much for joining in this conversation. We end our special coverage of the monetary policy. It's back to the stock markets where there is a lot of drama. That's after a short break.
You talk about the businesses that I lead. Even the textile business, when I started leading, today we are $1 billion in top line, but when I started it was just $400 million. But the word was around that, is Welspun really serious about doing anything? They have a woman at the helm of affairs, she doesn't know anything. And the irony was, the other side, the customer was a woman, the merchandiser was a woman, but it was a male-dominated society, a male-dominated industry. And I said, okay, let me do this. And I played on my strength there, Shireen. It wasn't about that, okay, I didn't know textiles. I didn't know textiles. I didn't know how the cotton was bought, how spinning was done, how was weaving done. I didn't know anything. I played on my strengths. And I think, Shireen, for all of us sitting here, I think we all have our strengths. We all need to play on that and see what we can do. And for me, I think that was a very interesting journey that began from there. And today, when I started, and today when I say today, we are highest in innovation, the ESG that we do, you can see a different perspective. And when you talk about that ambition, and we all urban here, but I have around 20,000 people working in my factories, and 30% are women. And imagine that ambition there. She leaves at 5 a.m. to come for a shift in the morning, doing everything, but an ambition to earn so that she can give.
Good morning. Welcome to the CNBC-TV18 HDFC Sky Election Headquarters. You're watching Trading Hour. I'm Reema Tendulkar, and with me is Surbhi Upadhyay. And Surbhi, there is no stopping this market. 23,000 has been scaled. It's a 1 percentage point plus gain on the benchmark indices. for the week so far. And this was a big week, the election week, and the benchmark indices have scaled a 2.5% return. And now I think we're going to start that countdown once again to our all-time high levels. 23,338 was the all-time high level on the Nifty, and we're just about 250 points away from that level. That's what, 1.1% away now. Not too far with the way we're moving up.
That would be quite something. I mean, to end this week at a fresh all-time high would be a statement. But, you know, just to take away from what the RBI has done, frankly, we'll ask our, experts, market experts this, but the policy didn't have anything specifically dovish. Nothing has changed. Rates haven't changed. The stance hasn't changed. Yes, the outlook on GDP growth has been revised higher. 7% becomes now 7.2% for FY25. The inflation forecast is unchanged at 4.5%. So not much. If anything, actually, there was a sense of hawkishness not on monetary policy, but on unsecured lending, with the RBI saying that the central bank is watching the incoming data very, very carefully, monitoring this data. And he acknowledged the fact that there has been some reduction in unsecured lending. And he said that, more actions could be taken if warranted, depending on incoming data on unsecured loans. So if anything, it was, slightly on the edge, so to speak. And of course, there was some mention of improving governance standards as well. He spoke about how regulated entities, are still not disclosing all the information in the key fact statement, which comes with a loan. So at the margin, there's no talk of any major bazooka from the RBI, at least not in terms of that language. But it seems that the market is moving on its own terms. And I think, Rima, it's more about the overall sentiment, sort of moving away from the slam dunk of Tuesday and perhaps starting to get a little hopeful and positive as we're looking at government formation, as we're looking at the allocation of the all-important portfolios. And maybe this is positioning, with the assumption that there will still be policy, continuity. And there won't be too many knee-jerk changes in terms of, what Modi 3.0 will deliver. Because this is a green-looking screen. Banks were underperforming, they still are, but they've kind of caught up. But yeah, the Nifty and the mid-cap index looking very good with that 1%.
As one of the guests had said, that we may not see big bang reforms, but policy continuity should definitely be there in the next 5 months. And that perhaps is enough, even if we don't get, big reforms. But, I think the surprise winner of this week has been IT.
Oh, yes.
The first half of the week was all about FMCG and the comeback of consumption spending, rural demand. But IT has now been the best performing sectoral index. Today it's up 3%, and this week it's seen a gain of 8.2%. And IT at current levels is the best performing sectoral index, followed by FMCG, which is up 6.1%. So this whole Nasdaq rally, Nvidia move may have had a rub-off impact on the Indian IT stocks. But let's begin trading hour by focusing on the markets following RBI's decision. We invite Ajay Srivastava, CEO of Dimensions Corporate Finance Services, to take a few questions. Ajay, morning. What do we start with? The way the markets have been whipsawed and now firmly up post the budget. The slam dunk on Tuesday, now the RBI policy. Take us through your market construct at this level. What have you made of the action, and how would you approach it?
I think it's been Rima, it's the best wake-up call investors could have had, because it was becoming so easy, the dartboard approach, buy what you want. And I think that one-day correction brought in a lot of reality to the market that things can happen. And when they happen with a vengeance. And which also tell you the Indian market is today sitting on a lot of leverage positions, because what happened that day was clearly leverage positions getting cut left, right, and center at market. So therefore, one should be cognizant that if one is investing at these rates, nothing wrong with, economy will continue. But what we came away take out, I don't think the RBI Credit Policy Committee has understood the mandate of the people. The people's mandate was against inflation, really. It hurt everybody and the common man more and more. And what I heard today is that inflation is not going to come down as per RBI policy at 4.8%, but there is a move by external members to say rate cut. That's not good news. RBI needs to be really focused on inflation reduction. And if it doesn't happen, this long-term rallies do fizzle out in the end, because inflation raises an ugly head and the political realities will start to catch up. Therefore, I think we are at this level, most of us are invested well into the market. We don't think there's a need to take further position in this market. If you got cash, at least 20% cash, hold on to it. And, and just wait it out, because I can see very clearly our analysts are telling us the leverage positions are getting built up rapidly again. And that is what happened 3 days back, can happen anytime. So keep some cash handy. People who had cash on that date, reaped a good dividend. If you didn't have cash or leverage and you were cut, you know what happened next morning. You were really very, very poor. So I would say, recommend very clearly is, I think, hold your positions today. Do not try to invest beyond 23,000 kind of indexes at this point of time. Let's wait for the budget. Let's see where it goes. Let the formation come through. There'll be enough time to invest. And FOMO is dead, as we all know.
And that's exactly what this market has been, made of. FOMO, right? FOMO that's making people buy stocks at 80 times, 90 times and what have you. By the way, 11 o'clock is also the NDA meeting. I think it's taking place in the Parliament Hall, where all the allies are coming together and then they'll discuss sort of the next steps. And we'll get you more on that as we go along. But Ajay, hi, it's great to have you with us.
Thank you.
How do you navigate a market like this? You have a big event, you have, a bit of a shakeout. It lasts for one day, and now you're talking, virtual all-time highs again. And this happening when FIIs are still selling, and that's my only concern. And I want your perspective on this, because that's a massive wall of selling that is still hitting us on a daily basis. And yesterday, domestic institutions didn't absorb all the selling. So it's very clear that retail and HNI is also buying. I don't know, does it make you feel nervous? How do you look at this?
I think the best people were who were away on a holiday on the election day, if you ask me, result day. Those guys came out the best because they didn't have to take a call either ways. So, that's why I said in this market, one has to be careful, cognizant of the fact that you got to take some money off the table. You got to be clearly invested in certain stocks. And over leveraging in this market is going to be a disaster, if you ask me. Definitely a disaster. So if you are out of the market and you want to now buy futures and options, I think that's not a smart idea to be. It doesn't matter. At the end of the day, the fundamentals count. At the end of the day, P's count. At the end of the day, realities come into play. And, we cannot be not aware that now we have a government which has to respond to two key issues in the economy, which is inflation and income diversity. That has to be acknowledged, is thing on the table. And if we thought it's going to be business as usual, I think they'll be fairly disappointed in the next 12 months to see that the government has now, whether it is a positive or negative stock market, I don't know. But I know for sure is not going to be the business as last year, because two issues on the table: inflation, which RBI did not address today, it kept it at 4.8%, and income diversity, the divergence of income which is taking place is there. So you have to calibrate yourself. As I said, you have to now very clearly book some profits. You have to very clearly, and when you say FIs are selling, it makes prudent to sell into the market which you yourself quoted, shares at 100 Ps, 200 Ps, 300 Ps. They may still go up. Nobody's arguing against the fact that it may not go up or the stock market. But the fact is, traditional wisdom, which is old age wisdom, which may not be applied today, says money in the bank is worth more than 2 in the stock market demat account.
I don't think many people have agreed with that theory, Ajay, and they're brave hearts, kudos to them. They like living on the edge, but I think it's been all about buying every dip, no matter if it is at all-time highs, and people are buying at all-time highs. The dip is 2-3%, right?
No, dip was not 2-3%. You saw what happened that day. The dip for 15%
on Tuesday, yes.
Stocks.
Yes, on Tuesday.
On Tuesday, 15% stock. So that's what I said. If you bought in cash, you got cash on the sideline, you can stay through the market. But if you're in leverage positions, and leverage position margin, you can't replenish like instantly in 1 second, you can't replenish market. Your position gets cut by the broker. And that's where the danger lies, that what we have seen in the last 48 hours is built up of futures back to where it was. And the numbers are coming out very clearly, showing that in every stock, we're seeing future build-up taking place. A lot of expectations. And I keep saying one thing, that if you made money, use the money, enjoy the money. There is no point of making money, seeing it disappear, seeing it come back, and then sitting on a sleepless night saying, what's going to happen on the budget day? So comfort of exposure is very important. I think all of us are sitting on huge profits at this point of time. You can add on. Let's take the margin at 23,000. You buy a Nifty. What do you expect to get? Maybe 2%, 3%, maybe 5% at the end of the day, right? Is that worth the risk that you run today? Or you carefully nurture your positions, wait for what happens in the market, wait for a good correction, and then go in. Runaway trains have a problem most of the times, and to expect that the interest rates are going to come down. I don't think it's the unwarranted optimism in the market that we are in. Inflation demon has to be slayed. Savers have to be rewarded. RBI governor actually alluded to the saying, listen, get your deposit things in order, which is really telling the banks that you've taken people for granted by not offering rate of return, so they're taking the money to the stock market. You give a decent rate of return, money will come back from the stock market to you. And I think it was very clearly said in the speech today that RBI wants deposit rates to go up in the market. So when deposit rates go up, you can't expect interest rate for lending to go down and banks to compress time. That won't happen. I think the scenario is going to be interest rates are going to go up in the economy in the short term further. I don't think there'll be rate cuts, and you need to be, your positioning of I think the stock market portfolio should be clearly aligned to what the government is going to do, which is, I think is going to be very clearly, a lot of it is going to be consumer focused. It's going to be GST rationalization, I think, is the key driver for this market. And I think we should wait and see whether the two-wheeler GST rationalization takes place, because that's a first trigger for textiles, garments, and is going to be two-wheelers. With that should tell the intention of the government.
So tell us how to construct a portfolio, right, at current levels. You spoke about GST rationalization, so that would put the spotlight in two-wheelers, textiles, etc. What else should one have in their portfolio right now? And where would you book profits?
I think it's going to be more and more defense at the end of the day, because that's the trigger is going to be, because our exchange rate under is not the best, healthiest exchange rate at this point of time. So defense remains a consistent theme. I don't think it's a thing. Capital goods, you can't switch off. It has to continue. When the plant starts to set up, it'll need the boiler, it'll need the system, it'll need the power. Power sector, I think, would be the biggest winner in this year, because that is where the major focus has to be. The demand supply is changing, the dynamics are changing, and at the end of the day, we need more capacity with this transmission. So I think power, capital goods, two sectors, defense, and these are old sectors, nothing new I'm saying, but these should continue to get priority. Whilst at two-wheelers, tractors, I think on the agriculture side, all the input companies are, I think, going to see a decent bonanza, because that's where the government would possibly focus, given the realities of the political situation at this point of time. So agri inputs companies, agri-related tractors, tillers, I think they're going to have a swell time at this point of time. And of course, you know, the best part is India has so many restructuring stories, so many demerger. If you look at the largest groups, they are doing demergers and bringing in businesses, whether it's Reliance, Grasim, whichever it is. And I think those stories will give very good returns to the people at this point of time. So, you know, nothing changes very much, but what changes is some new things may pop up post GST rationalization, post the government's new stance in the budget.
Okay. All right, Ajay, we will have to leave it on that note for today. Thank you very much. We are in very interesting times, and we look forward to more such conversations with you in the near future.
Good day.
Thanks for joining in. All right, we have to take a quick break. Let's take that break and come back on the other side and get Mitesh back in. The market has been surging in the last 1 hour or so. So good time to talk about some more trading ideas.
To her children. I think it's a dream. And I think, Shreen, if we all can do that, if we can really make and inspire women. So for me, that's what it is. I think if I can open that door for those many women, I can open that door for those women in the communities who are earning around 20,000 rupees, sitting in the village, where they can give and buy a better kind of a life for their kids. I think that's what it is. And it is this India we are talking about. Yeah. We are sitting in Mumbai. It's that India in the hinterland you're talking about.
Neetu, let's talk, 8%. I was talking to Dipali about that 8% number. You're a chartered accountant, one of the brightest young chartered accountants recognized so by the ICICI. And what, 8% chartered accountants over 20 years ago, and today that number is again about 30-odd% or 20%. A significant improvement there. Take me through your own journey, Neetu, and now from Jyoti Laboratories to CFO to Managing Director of VIP Industries.
Yeah, it has been an interesting journey. Tough anyways, that has to be because we are women. But yes, I'm from a very conservative Marwadi family. So to do a CA itself was a task. And as soon as I finished my graduation at the age of 20, and I'm from a conservative family who even didn't allow me to go to a co-ed college. So I was said that if you want to go to a college, then only girls' college, otherwise no college. So from there to here, it's a journey. And at 20, as soon as I finished my graduation, I was told that abhi shaadi kar denge. But yes, I said no, I want to do CA. And my dad said, nothing doing, whatever you want to do, go to your in-laws' house and do. I am not allowing, you have to get married, otherwise I'll not get a boy, because CA means 3 to 4 years and you're already 20 and 24 pay, I don't think you will get a good boy.
It's an IT day today. The IT index is up 3%, and one of the big movers is Mastech. Now, the news here is that the company has a consumer experience platform. It's called ICX Pro.
That's not what caught my eye. What caught my eye was there's some NVIDIA link, right?
So basically they have a platform, and that platform they have upgraded by using NVIDIA's computing prowess, right? So this platform is now so much more superior. So that's the key development. The company is saying that the platform will now enable development of generative AI applications for enterprises. So enterprises can now use this platform to come up with their own Gen AI applications depending on their domain. And they've said that this has reduced customer response time from 3 to 7 days to a second. That's the extent of the, let that number come up. There you have it. Reduce the customer response time from 3 to 7 days to a second. So they're seeing a lot of potential for this particular in various sectors. So it could be in manufacturing in particular, where one of the use cases or test cases showed that they've demonstrated a 20% return on capital. They see a massive potential in manufacturing, BFSI and the healthcare sector. So that's gotten the street excited that one of their platforms is now been advanced with the help of NVIDIA's computing capabilities. But the other stock which is on our radar is Wipro, because the company has won a large deal, a $500 million deal from a US communication service provider. The company has not named the client, but it's a $500 million spread over 5 years. It's a net new deal, and therefore the incremental revenue addition, we can estimate it. They've not given it by the company, but we can estimate it to be about 0.8, 0.9% this year. And this is the first major deal under the new CEO, Srinivas Pallia. That's the Wipro update for you, the IT update, Mastech and Wipro on our radar. But let's invite Mitesh Thakkar now for a quick technical check on the markets. Mitesh, firmly above 23,000. Is there a trade that you would recommend?
In fact, I didn't expect 23,000 to be crossed so easily. So maybe not, but on the indices, I think the Bank Nifty could be a buy if we get spot levels of around 49,430, which is roughly about 150, 200 points lower. Then we want to take a long with the stop below 49,000. And on the stock side, I have a buy on Sun TV with today's low as the stop loss. 709 is the stop loss, 755 is the target. And that apart, I think, we've been recommending a lot of IT names, but now I think SBI Life is also coming to, SBI Cards is also coming into a buy zone. So buy here with a stop at about 709 and look for target of 745.
Okay, got that, Mitesh. Thank you very much for those ideas. We'll come back to you later in the afternoon. Let's see how the day progresses. We do have to take another quick break on that note. We'll come back on the other side and put the spotlight on a couple of stocks that are buzzing specifically because of the hope and expectations that there will be a lot of developmental activity now in Andhra Pradesh. So what are these stocks and what's the fundamental input around them? We'll tell you.
I did not leave it. I actually started crying. Next 7 days, I did not leave him till he said yes. So yes, he said yes.
The power of tears.
Power of tears, and I would say perseverance and not leaving it.
Yeah.
And date raho, ki I have to do it, and he allowed, and that's how it happened. And then the time came when I was about to get married, and he started seeing boys. Again, a similar challenge. Every boy who was a chartered accountant, knowing how difficult it is, still wanted a housewife. They didn't want a chartered accountant. And then we got one biodata where chartered accountant, service class family, my father-in-law was working with Grasim. And I thought this is a good chance because somebody who is in service class might be more progressive as compared to the others. So before my dad met this boy, I went to a Yellow Pages, searched his number because those days there was no mobile.
Well done.
And called him to meet. And 3 things which I told him that time. was, one, I will decide whether I need to work or not. Second was, my complexion is dark. He was very fair. I said, generally in Marwadis, you know, this black and white is quite prominent. I have no makeup on my face. Please look at me and decide. And the third thing was, every father wants to give more than what he can to his daughter, so please do not ask for dowry. And these three things, he got confident, and he loved my confidence, and he's my husband today. And he's helped me reach my career. He built my career. Many times he has sacrificed his career for me. And yes, journey started. Then I started working with Keval Kiran. I was quite happy. 2 years passed away. And then one day in Ascent, I saw that there's a company who has advertised a finance professional.
Welcome back. You're with us on Trading Hour. As promised, let's get to that analysis on companies and stocks that are linked to Andhra Pradesh. And with Mr. Chandrababu Naidu now all set to become the next Chief Minister of Andhra Pradesh, the street is betting on Naidu's pro-development focus. And this is leading to excitement on a lot of these stocks. We have Nigel with more details. He's been tracking quite a few of them right from the 4th of June, Nigel.
Well, that's right. You know, we had highlighted about KCP having some exposure to, the belt. That's Andhra Pradesh as well as Telangana. And that stock did very, very well. So we said, let's delve a little bit more into it. Now, Mr. Naidu is set to become Chief Minister yet again. And expectations are that the TDP government, they'll go ahead and they'll revive that Amravati capital plan. Remember, it was talked about in his last avatar as well, or his last tenure as Chief Minister. So they believe that things will be back on the table. And that's why, in fact, you're seeing that some of these cement stocks are rallying. Now, that's the broad number you should be looking at. You know, the biggest name of the cement industry is obviously UltraTech Cement. But in percentage terms, the exposure to AP Telangana is relatively lower. Ramco Cement's close to around 30% of their total capacity is in Andhra Pradesh as well as Telangana. So that one should be on your radar as well. Could explain why the stock has bounced off quite well in the last 2-3 days or so. And Sagar Cement's KCP as well as NCL, they are smaller players, but bulk of their capacities are in this region. And that's why the street is getting excited about them. On a valuation parameter, UltraTech obviously it's the king, so that commands higher valuations. Ramco Cement, I recall at one point of time used to trade at around $150, $160 per ton. Now, in fact, it trades at around $120 per ton. So on a valuation basis, it's relatively more attractive provided demand comes back. And Sagar as well as NCL, well, they are trading at mouth-watering valuations, as was the case with KCP. Giving you a couple of inputs on each of these companies then. Sagar Cement, the enterprise value on a per ton basis is $49 per ton. The sales volume guidance that they've given is around 6.5 million tons. And some part of the street is very disappointed. When you have capacity of more than 10 million tons, why are you giving only 6.5 million tons? But with this sort of a move coming in and if development, comes to the fore, particularly in Andhra Pradesh, well, then they could very well go ahead and achieve these numbers. And what's more important is they have a capacity of around 10.5 million tons, which is going to around 11.3. So in case there is big development, they already have the capacity to go ahead and sell their cement as well. The street, though, is waiting for some clarity on a 100-acre land that they have. That was the one that came in with Andhra Pradesh. So that's a trigger because that could bring in close to around 400 crores at around 4 crores per acre. Moving to NCL Industries, another small player, and more than 85% of their total revenue mix is coming in from cement. The boards and the RMC business, they're profit making, but that's too small, so we're keeping that out of it. And those which is only around 1% odd, that's actually currently not making any money. But for the time being, we're focusing on their core business, which is on the cement business. Now, out there, they're expanding capacity from around 2.7 million tons to around 3.5 million tons. In the last couple of years, they have been talking about this, but in the in the previous government, they couldn't go ahead and increase their capacity. Now they've got their clearances. So by September 2025, the capacity will go to around 3.5 million tons. And not valuing the other smaller businesses, but just taking the total enterprise value, it trades at an EV per ton of around $41 per ton. So that as well is quite attractive. So that's another company that you should keep on your radar. And just to recap what we already explained to you earlier in this week, KCP, The capacity is around 4.3 million tons. They have a sugar capacity as well in there. And the total consolidated EV has now moved to around 2,500 crores, 3,000 crores of market cap. You deduct from that the net cash of close to around 500 crores. Now, just solely valuing the cement business itself, if you give it a value of around $70 per ton, then the cement business will be 2,500 crores. That's at the upper end. When we covered it earlier, it was at around 1,800 crores. Now, KCP, besides having a cement business, they have a lucrative business in Vietnam, where they're making a good amount of revenue as well as EBIT. So that one, in fact, that explains why that's been one of the biggest movers. So keep an eye on some of these cement players. For the time being, the street believes Mr. Naidu coming back will be pro-development. And that's why all these companies, they are up anything between 8 to 10%. KCP is in a league of its own. All of them are higher in this past week itself. Back to you guys.
Okay, thank you very much for that. He was also seen as quite the tech CEO. He was very bullish on, technology. He managed to get many of these large MNC technology companies to set shop in Hyderabad, because that time it was only Hyderabad, which was the capital of, it was not divided between Telangana and Andhra Pradesh. So, he made Hyderabad the tech, big technology city. And now the expectation is that once again, he could mobilize
and
forces
Rima,
for
just
that.
to quickly put in, because we need to wrap up, but just to quickly move in as well, even some of these infra-related companies, they believe development is going to be, very, very high. There's not going to be any pending funds, and they're bracing for huge orders, which explains why some of these companies have moved up as well.
Okay, thank you very much for that. Get into a break. On the other side, Dhaval Gada from DSP Mutual Fund will join in to talk about the trends in the BFSI sector.
Only women should apply. In 2000, okay? And I told my husband I have to work for this company only. He said, you don't even know what the profile is. You've not met them. How can you make this judgment? I said, in 2000, this is 2000, a company who has guts to write that for a finance professional, those days it used to be only men apply. And they wrote this, so I salute them and I want to work. It really worked very well for me. I started as an assistant manager and left as a vice president, worked for 17.5 years, and did everything which a finance professional can dream of in that organization. And then Greaves, and finally VIP Industries I joined in 2020, peak of COVID, when our business was zero. I think did some good work, and the promoters gave me appreciation, and today I got this role just 7.5 months ago.
देशवासियों को
अगली चुनाव सर्दियों में कीजिएगा और वन नेशन वन इलेक्शन वाला
आपने सही मुद्दा उठाया। वन नेशन वन इलेक्शन हमारा एक कमिटमेंट है। हमने पार्लियामेंट में भी बोला हुआ है, हमने कमेटी भी बनाई थी, कमेटी का रिपोर्ट भी आया है। तो वन नेशन वन इलेक्शन।
Welcome back. You're with us, and we're coming to you from the CNBC-TV18 HDFC Sky Election Headquarters, and you're watching Trading Hour. Well, the RBI policy statement has just gotten over, and there's been no change in either the stance or on the rates per se. But there are some interesting tidbits in the beyond monetary policy announcements. For instance, the definition of bulk deposits, that's been changed from 2 CR to now 3 CR. And the RBI governor made some very interesting references to unsecured lending and how the RBI is watching that, quite carefully as well. Let's discuss some of these trends with our next guest. We have Dhaval Gada, Vice President of DSP Mutual Fund, who's joining in. And Dhaval is someone who manages DSP's Banking and Financial Services Fund. So you're a great person to have on a day like today to talk about what lies ahead, Dhaval. Thanks for joining in. So before we talk about your holdings, the fund and the positioning, let's get your reaction to the policy out of the way. What did you make of it? Specifically, some of these nuances, the reference to unsecured lending and this change in definition of bulk deposits. What do you think it changes, if at all? I mean, anything at the margin?
Yeah, so I think, from a rates perspective, we expected unchanged stance and the policy rate. and the key focus was supposed to be on the guidelines around unsecured, around loan to deposit ratio, around other aspects of regulatory action that we've seen over the last 4 or 5 months. And from that perspective, not surprised that RBI has again reiterated its stance on some of these aspects. And so from that perspective, I think the only change is that RBI has again hinted that some regulated entities are not following their guideline on key fact statement and the loan to deposit moderation that the regulator is seeking for. So that we will watch out for this. As far as bulk deposit is concerned, on the margin, I think it sort of is a refresher from earlier change. So it moved from 1 crore to 2 crore a few years back, and now from 2 crore to 3 crore. In terms of its impact, we may see some bit of increase on the rates, especially on the bulk side, given the overall framework of having deposit growth being higher from where it is right now. So on the margin, it should put some pressure on spreads over a period of time.
Interesting. So you're saying this increase in the bulk deposit definition, that will cause maybe some margin pressure, because obviously banks will offer higher rates there, and there's been a lot said about the scramble for deposits. Any guess right now in terms of how much pressure on NIMs because of this move alone?
Difficult to quantify only because of this aspect. I think if you look at the broader theme, the regulator wants banks to have a faster deposit growth, or the gap between credit growth and deposit growth should be lower than where it is right now. And from that perspective, the idea is to make it more attractive for depositors both on the retail and the bulk side to sort of mobilize deposits. So net, the direction of the regulator is only going to increase margin pressure, because the credit to deposit ratio from where they are likely to move downwards versus upward trajectory that we are seeing for the last year and a half.
So not for this move itself, but in general, I mean, what are you factoring in? How much of a margin compression are you factoring in because of other reasons as well? Because of the scramble for deposits, because while that sort of puts an upward pressure, there's the overall expectations of rates coming down as well. So what is the margin compression you've right now penciled in for NBFCs and then for banks?
So from NBFC's perspective, we expect about, depending on each model, but broadly, I would say 25 basis points of decline for the larger names from where we are at the end of fourth quarter. And as far as banks is concerned, 10 to 15 basis points of decline for FY25, with assumption that the rate cut cycle begins at the end of December or February. So back-ended rate cut cycle. So those are broadly the thought process on margins for both banks and NBFC.
So 25 bips compression for NBFCs, and banks, you said? Sorry, I missed that number. 20 basis points.
10 to 15 basis points.
10 to 15 basis points. Okay. So that's sort of the immediate impact in terms of policy announcements. Just one more piece on unsecured, Dhaval, because we heard the RBI governor very clearly give a reference to this again. He did say that overall, loan growth in this segment has come down, but the central bank is still watching and will take more action if warranted. Could this be an issue? Could this be a challenge with respect to, further pressure on loan growth?
So actually, I don't think, from where we are, there is going to be further pressure on unsecured credit. So if you look at the journey over the last 3 years, post-COVID, we did see significant uptick in unsecured credit growth. And at a system level, we moved to about 30% kind of credit growth, which is when the RBI came quite heavily in terms of first their commentary and then steps in terms of risk weight increase and other specific measures. To sort of calibrate this upward move that we were seeing. And over a period of time, we were expecting this growth to moderate, given the base effect that would have caught up anyways. So where we are is close to around 20-21% kind of growth at a system level for unsecured credit. And for next year, we do expect this to converge close to broad system credit growth, give or take about 4-5 percentage points. So it will be most likely sub 20% next year. So directionally, we are moving in the right direction from a regulatory standpoint, and I don't think there will be too much change on that count, unless the regulated entities go quite aggressive again, which looks very unlikely at this stage.
So next year, you're saying FY26, that's when unsecured loan growth should fall. Sorry?
FY25, we expect it to be sub 20%.
Yeah, I was just checking because you said next year, so was wondering which one you're referring. So 25 is what you're talking about. By the way, Dhaval, we have you actually on a great day, because we are just getting details on the Bajaj Housing Finance IPO as well. I think there were some flashes there, and the size of that issuance is going to be about 3,000 crores. So that's the next big development. What is your stance on housing finance companies? What's the outlook, and what do you think this kind of a big IPO will mean for the sector?
So first on the sector, we expect the growth moderation that we had seen in housing post COVID to sort of come back and be in around the mid-teens kind of level. And given the government's thrust on housing, we do expect this growth to sustain for a few more years. In that context, in the large housing finance company space, we did see one large merger in 2022, and this space is largely there's a gap in the listed universe at this point of time to play a large prime or super prime housing space, and from that perspective opportunities are limited, and therefore some of these new offerings would be quite attractive, assuming the valuations are in a reasonable zone. So that's broadly the thought process. Overall, very constructive on housing finance as a space, and within that, prime and super prime is a very good opportunity to look at.
Okay, well, I'm just telling our viewers that Bajaj Finserv and Finance both are big holdings for the DSP BFSI fund. Bajaj Finserv, the weightage is about 9% in the portfolio. Bajaj Finance, the weight is about 5% in Dhaval's portfolio, in both those stocks in focus today. Bajaj Finance, of course, doing really well. Now I'm looking at the rest of the portfolio as well, Dhaval, and obviously, lots of big private sector banks which form the bulk of your HDFC Bank, ICICI Bank, Axis. You do have exposure to some of the smaller PSU banks. But let me ask you a broader question. Where will money be made? That's what everyone's looking at now. Is it going to be time for private sector banks? Is it time? Is it time to, let's say, unload a bit of the PSU and move that money to private sector? How would you approach it?
So, I mean, my portfolio construction has been very stock-specific, bottom-up, and therefore, when you look at active weights in the portfolio, they are in the names that you mentioned, the Bajaj Finserv, REC, those are big active weights in the fund. And so, broad thought process is, we expect corporate credit growth to see very good momentum. We've seen last 2 years being quite good. After a drought of 8-9 years, we've seen corporate credit growth come back, and we expect this cycle that we are in with the thrust that the government has put on capex. We expect this trend to continue, and therefore that's one area where we think there's still value, and we're quite constructive around that space. The other pocket that we are quite upbeat on is diversified NBFCs, where we think there is a case where with the uptick that we are seeing in GDP growth, last year also we saw a revision upwards, and in the current year as well, based on RBI's forecast, we are seeing an upward revision, and similarly we've seen that in credit growth as well. So we do see a case where growth compounding is going to be quite strong in some of these diversified NBFCs. Coupled with the rate cycle benefit, the earnings compounding can be even stronger, is our thought process over the next 2-3 years, and therefore that is one more area that we are quite constructive on. At a broader level, the large bank space, I think they are very reasonably priced at this stage, and therefore they become the anchor of the portfolio, where we expect them to at least give market or market plus a few percentage point return and give stability to the portfolio.
Okay, all right, Dhaval, good talking to you. Good conversation. Thanks very much for joining in, and we look forward to more of these in the future. All right, well, on that note, we do have to take a quick break with the news that the market rally is going from strength to strength. Look at the Nifty now. It's a 350-point up move. It's a turbocharged market. and a market which is now less than what? We're talking about 200 points, from less than 200 points from fresh all-time highs, turning out to be quite a session today. We'll take a break, come back on the other side, and also tell you what's happening in the commodities world.
देश में बहुत लोग ऑन बोर्ड आए हैं, सभी दलों ने, बहुत लोगों ने इसमें जो कमेटी को अपना सुझाव दिए हैं, बहुत ही पॉजिटिव सुझाव आए हैं और बड़े इनोवेटिव सुझाव आए हैं और देश का बहुत बड़ा लाभ होगा अगर हम इस रिपोर्ट को लागू करवा पाते हैं तो।
जी, धन्यवाद मोदी।
नमस्कार, थैंक यू।
Create more magic in the world. With those words, the founder of Airbnb, Brian Chesky, launched their latest offering, the Icons, 11 iconic properties that have, in a way, been created or curated by the Airbnb team up for listing. What you see right behind me is the Up House, the iconic flying house. It actually does fly just like the house in the movie where the lead character Carl went in search of Paradise Falls. So let's take you inside to see what the Up House recreated by Airbnb is about. Everything in the house has been recreated by the Airbnb team down to the minutest details, including the rust on this piece right here. It is quite literally a flying house. You have the balloons just like you did have in the movie, but the actual flying is done with the help of a crane. So if you do decide to list the Up House on Airbnb, then get ready to be lifted off the ground. Products must have a soul. That
Welcome back. Manisha is now joining in, and this time she's going to be focusing in on the progress of the monsoon. Hi, Manisha.
Well, the good news as far as monsoons just about continues, well, there were concerns of monsoon stalling or the progress slowing in the previous week, but that seems to be really picking up right now as there are cyclonic moves there. So we are looking at 1st to 5th of June monsoon. Overall, India 7% above normal. The IMD says that the monsoon progress further is into parts of Karnataka, Maharashtra, Telangana and Andhra Pradesh as well. The IMD also says that the conditions are now favorable for the advancement of monsoon into Mumbai, Telangana, South Chhattisgarh, South Odisha and also west central parts. There actually is an orange alert for heavy rains in various parts of the country. That is from 8th and 9th of June. This is in Goa, Konkan, Madhya Maharashtra, Karnataka, Assam and Meghalaya. While there are concerns, of course, in some parts of the country as far as heat waves as well goes, and this also is an advisory till 9th of June in parts of Uttar Pradesh, Madhya Pradesh, Bihar and Jharkhand where the temperatures are above normal. But the southwest monsoon is now looking to enter Mumbai in next 2 to 3 days. The monsoon has reached parts of Kolhapur, Satara and Ratnagiri within Maharashtra as well. These are areas not too far away from Mumbai. There also is, by the way, a yellow alert for Mumbai on 10th of June, not just in Mumbai but in Thane and Raigad as well. So the monsoon progress does seem good right now, and the expectation that the month of June could be looking at a monsoon average anywhere between 92 to 108% on the higher side seems to be happening as of now.
Okay, all right. Thank you very much. Waiting for those rains, Manisha. So you're bringing us some good news there. Let's take a quick break. We'll come back and towards the end of the show, we'll bring you the latest from New Delhi. All the political developments as the NDA's big meeting with all the allies is underway in Parliament.
philosophy, and that has been the driving force for Airbnb since its inception in 2008. The company turned a unicorn in 2011 and then saw its mega IPO in 2020. It is now ready and on the cusp of making its next big leap. The Icon's launch was just a glimpse of what the potential future looks like. Markets have not just grown, they've broken several records in the last 25 years.
India's contribution to incremental global GDP was as low as 0.2% 25 years ago.
Over the last 25 years, CNBC-TV18 has closely followed the remarkable ascent of India's pharmaceutical sector.
There was a time 25 years back that it was all about the FIIs. If FIIs would buy, markets would rally. If FIIs would sell, market would fall.
Earlier, we were net importers of steel.
From IT services to SaaS, from consumer electronics to space tech, from mere programming to AI ML.
Cars, two-wheelers, three-wheelers, commercial vehicles have significantly become much more expensive than they were 2 decades ago.
It's a bull charge on the street. The Nifty is moving very swiftly and we are almost now talking 380 points. In fact, the index has just now crossed the 23,200 mark as well. So this is absolutely incredible. We're 135 points, 137 points away from fresh all-time high. Some serious momentum in the market. Well, on that note, let's move on. And as promised, head to New Delhi. We have, of course, our colleague Parikshit joining in to bring us the latest in terms of that big NDA meeting. We're seeing some of that footage come in as, of course, the next steps in government formation take place. Parikshit, what's happening today?
All NDA leaders and elected MPs have arrived in the Central Hall of Parliament. They are meeting to discuss the way ahead. And all MPs, all NDA leaders have given their support to the BJP-led NDA to form the government. Key allies here are the JDU, the TDP, the Shinde Sena, the LJP and other parties as well. Now, all of them need to be accommodated in some way or the other, and there is a hectic negotiation taking place in the capital. Portfolio berths have not been finalized as yet, but we've been given to know that both the JDU and the TDP are asking for 4 to 5 portfolios each, and both these key allies have asked for important ministries related to transport, infrastructure, railways, rural development, industries, and agriculture and farmer-related ministries as well. So it's going to be difficult for the government to accommodate all these demands. Now, there are some reports that the TDP has sought the Speaker's post, but we're given to know from our sources that the BJP would like to retain the Speaker's post with itself. The swearing-in ceremony will take place in the evening of 9th June. At least 5 foreign leaders, heads of state, heads of government have been invited for the swearing-in ceremony. This includes leaders of Maldives, Sri Lanka, Bangladesh, Nepal and Bhutan as well. So it's going to be a very important ceremony, and the Prime Minister, the BJP would like to give due importance to all the allies here as well.
Thank you, Parikshit, for all those important details. With that, it's a wrap on Trading Hour from the entire team. Thank you for watching. Stay tuned. Halftime Report is up next.
Discounting is high there, but their focus is squarely on the 125cc segment.
Now it is contributing 16% of incremental global GDP.
Now we are looking at exporting the steel that's made here in India.
Welcome to the first ever India Business Leader Awards.
cars, two-wheelers and vehicles generally being manufactured today are much lower on emissions and much higher on safety.
India's technology industry has been at the forefront of cutting-edge innovation over the last 25 years.
It's the retail which is the driving force for the market right now.
Clearly, we have arrived on the global economic stage.
Great way to celebrate our own 25th year with new milestones being achieved on the Lal Street.
21 years of the Nifty from 1,000 to 10,000 today. Sensex and Nifty hit a record high.
The Nifty rallying to a record high.
We invite you to join us as we persist in leading coverage of the pharmaceutical and healthcare domain, documenting India's expanding expertise in medicines.
25 years of excellence and unparalleled growth.
CNBC-TV18, embarking on a quarter century of excellence.
Export front, I think, the businesses are doing well from what I understand, from whatever I've spoken to, whether it's pharmaceuticals, because generic pricing is reasonably supportive. You're not seeing the kind of year-on-year declines that you've seen over the last 3 years. I think the only headwind there is potentially increase in shipping costs. So that would be a minor element, I would say, as a headwind, but I think I see a reasonable amount of tailwinds.
Earlier interactions, we've mentioned that the board has set up a search panel that's going through its process. I'm sure, be sure when the regulatory approvals come in, it will be first flashing on your screen. So beyond that, it's hard for me to even make any comment because the process is in an advanced stage, but underway. So beyond that, really no comments. It would be inappropriate to make any statements. The regulatory process is underway. The search panel is doing its job and doing it very well. All I know is they have a rich slate of candidates.
स्वागत है भाई, स्वागत है। 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 स्वागत है। हम सबके लिए गर्व और गौरव का क्षण है, माननीय प्रधानमंत्री जी।
Acha, sorry, you have to. Okay, is over. Thank you. Yeah, let's start.
So, with your permission, sir. Yes, sir. So, hello and good afternoon. Welcome to the post-policy press conference. Today we have with us Governor Reserve Bank of India, Shri Shaktikanta Das, Deputy Governors Dr. M.D. Patra, Shri M. Rajeshwar Rao, Shri T. Ravi Shankar, and Shri Swaminathan J. We also have with us Executive Directors Dr. O.P. Mal and Dr. Rajiv Ranjan, and other colleagues from Monetary Policy Department. To begin with, I would request Governor to make his opening remarks, and thereafter we'll move to Q&As. Sir, please.
Good morning and welcome to all of you. Nice to see you after a gap of 2 months. I'm not going to say anything new, but basically what I have tried to do is I have tried to capture the highlights of this monetary policy, the statement which I made. So I have culled out certain relevant portions just to put things in perspective for better clarity for you as well as for the wider audience which may be watching this program. I have about 10 points to make, and they are very short points. and it goes like this. First, growth inflation balance is evolving favorably as per our projections. 2, headline CPI inflation is moderating, but the last mile of disinflation is sticky. Our target is 4% on a durable basis, and we will work towards that. 3, our monetary policy is primarily guided by domestic macroeconomic conditions and the outlook. 4, GDP growth outlook is bright. The momentum of economic activity is well sustained. GDP growth projection of 7.2% for 24-25, when it materializes, will be the 4th consecutive year of growth at 7%, of growth at or above 7%. So, I mean, if you see the last 3 years and the current year, either the growth would be at, when it materializes, the growth would be at 7% or more than 7%. In fact, the average growth in the last 3 years, ending 23-24, the average growth in the last 3 years exceeds 8%. If you take the average of growth in the previous 3 years, it exceeds 8%. 5, liquidity management will continue to be nimble and flexible. 6, the financial sector continues to be stable and resilient. 7, foreign exchange reserves have reached a historical high of $651.5 billion at the end of May this year. 8, the external sector is expected to remain stable. 9, the Reserve Bank stands committed to maintain stability and orderliness in all segments of the financial markets and institutions regulated by it. 10, the agenda for the run-up to RBI at 100 has been given out as part of the monetary policy statement. It's given out in the annex to the monetary policy statement. This is a dynamic document and will be updated as per requirement. Thank you.
Thank you, sir. Before we start, I'll request the media friends present here to wait for their turn before asking questions. Also, please restrict to 1 question per person. If time permits, we can go for another. So I'll call out the names now, starting with Mr. Govardhan Rangan from Economic Times. Sir.
Thank you. Good afternoon, Governor. So one of the things that one of the things that you have been reiterating is that you don't follow the Fed, and the domestic policy decisions will be based on the domestic considerations.
Yes.
That is also being interpreted as a kind of a dovish sign, in the sense that even if the Fed doesn't ease, okay, you would really go ahead and ease when the conditions permit. Is that the right interpretation?
The converse can also be true. In other words, even if the US eases, we may not. So therefore, I would suggest that there is what I have done is that I have just explained our overall approach, and I have done it in the past. I decided to reiterate it again, for better clarity.
Thank you, sir.
Yeah.
I'll request Ms. Lata Venkatesh from CNBC.
Thank you very much. Governor, sir, in your para 22, where you speak about unsecured retail loans and, coming down, just I'm reading, recent data suggests that there is some moderation in these advances. We are closely monitoring incoming data and to ascertain if further measures are necessary. Can you clarify if further measures are necessary? That's vital to both consumers as well as to banks. And of course, if you don't mind, sir, you said you will give us the neutral rate after the GDP comes, the newest calculation.
DG Swaminathan can take that question.
Sir, I think I would like to only reiterate what is stated there. We are closely watching the incoming data, and any measures, if necessary, will be basis the reading of the data. I don't think that you should read more than that in that at this point in time. Thank you.
The message is to convey that RBI is watchful of every aspect of, you know, the overall